If every single customer of a bank asked for their money back tomorrow, the bank couldn't pay them all. And that's actually by design. Today we're talking about bank reserves, the money banks hold back instead of lending out. It's a small piece of banking that quietly keeps the whole system standing. No advice here, just how the concept works. When you deposit money in a bank, the bank doesn't just lock it in a vault labeled yours. Most of it gets lent out to someone buying a car, starting a business, or buying a home. But not all of it. A portion stays behind, either as physical cash in the branch or held in an account at the central bank. That portion is the reserve. Think of it like a restaurant keeping a float of cash in the register. Not their full earnings, just enough to handle the next few transactions that walk through the door. This is where reserve requirements come in. Regulators set a minimum fraction of deposits that banks must hold back. They can't lend it all out, no matter how good the borrower looks. Picture a lifeguard rule at a pool. No matter how calm the water looks, one lifeguard always has to stay on the deck. It's not about distrust of the swimmers. It's about being ready if something unexpected happens. Reserve requirements work the same way. They're the buffer that's there before it's needed. So what does this actually do in practice? It shapes how much a bank can lend. A higher reserve requirement means less money flows out as loans. Credit tightens. A lower one frees up more lending. It's one of the levers that connects a single bank's daily operations to the wider flow of money in the economy. Reserves are the difference between money a bank has and money a bank lends, and that gap is what keeps the system steady. That's reserves in one idea. Next time on MoneyMind, we're zooming out to the bigger picture, what actually happens during a recession or a depression. Subscribe so you don't miss it.